A very warm welcome to all of you on behalf of Azim Premji University. We are delighted to be presenting today's program in our series of public lectures here in Bangalore. Public lectures are one of the ways by which the Azim Premji Foundation promotes its vision of a just, equitable, humane, and sustainable society. I know many of you have come from far, including several of our students who have braved the Bangalore commute to be here. Many of you were here for our last public lecture too, last month, when we hosted Michael Spence, the Nobel laureate in economics. I know all of you come here because you are invested in education and development of the country, and because you are well-wishers of the Azim Premji University. Thank you very much. A bit about the program this evening. Soon after this introduction, Neelkanth Mishra will deliver his talk for 45 to 50 minutes. He will then be in conversation with my colleague, Lakshmi Narayan. With a name like Lakshmi Narayan, you know what his role is. He's the Chief Endowment Officer of the Foundation. A brief introduction to Neelkanth. Neelkanth's CV was part of the invitation, so I will just pick up a couple of highlights. He had a blazing academic career, standing fourth in the JEE. His father, like most Indian parents, must have asked why he couldn't get the first rank. Neelkanth went on to, therefore, get the President's Gold Medal from IIT-Kanpur. He is Chairman UIDAI, easier to say Aadhaar, Chief Economist of Axis Bank, and I believe has the years of successive governments, including in his role as member of the Prime Minister's Economic Advisory Council. Neelkanth will now deliver his talk on India's growth path, structural and cyclical factors. Please join me in welcoming Neelkanth.
Thank you, Sudhish, and thank you, everyone. Look at the left-hand slide here, the chart here, and what you see, there is a maroon line, is where India's GDP would have been if COVID had not happened, and the black line is where the GDP is and how it is trending. What you see on the right is the gap in the number of years of growth that we have missed. So what you see is that we are about 1.2, 1.3 years behind where we would have been if COVID had not happened. The maroon columns are for the world. So the world is also mostly there. Of course, there is a lot of disparity. The US is actually ahead of where it would have been if COVID had not happened because of a lot of fiscal intervention, which is also something I will touch upon. China and Europe are well behind where they would have been. This is a framework. So now the structural versus cyclical. One useful framework for splitting growth or rather forecasting growth is to divide it into labor input, capital input, and total factor productivity. So what does that mean? If, say, in my research team, I want to increase the research output, I can add to the research team. So if I have more research people, I can put out more research. I can give them access to databases, which is capital input, give them faster computers. Or I can also, I can also get them to collaborate better and come up with ideas better, produce faster. And that's total factor productivity. Given the same amount of workers, same amount of capital, if I can get my output up, that's TFP. That, in very simple terms, is how the economy works as well. So if you see the left-hand side chart, this tells you for every 5-year period starting 1980, how was India's growth split. So the bottom two parts of that stacked column are labor input. So the dark maroon is labor input in quantity. There is a dark gray which is labor quality, which is measured as the average number of years of education. The pinkish section is the capital input, and the light gray is TFP, right? So the bottom two are what you would call labor input. You can see that in the 1980s, though India's economy was growing at 5.5%, nearly 3% was just coming from labor input. So as our population growth has slowed, that contribution has been coming off. So in the last 5 years, and this chart ends in 2019. So if you think about the next 5 years, I think it's a reasonable assumption that our labor input will grow at about 1%. If you're fond of history, and increasingly as I get older, I'm becoming fonder and fonder of history, you will see that everything in human life is a cycle. So, but still, if something lasts 50, if the cycles are 20-year, 30-year, 40-year cycles, we can safely call them structural. So this is a structural factor, that the number of people joining the workforce will keep growing at a certain pace. The number of years of education will keep going up for a while. We are already seeing that the percentage of 18 to 25-year-olds who are graduates or in college is now 4x what it was in 2006. So there's a substantial improvement. So this will continue happening. So labor input, I think it's reasonable to say, will grow at 1%. If we are lucky, it can grow at 1.2, 1.3%. There are some very early signs that female labor force participation is actually starting to go up, and I'll comment on that in a few slides. The light gray portion, and I'll spend some time on that, is the total factor productivity, and I'll run you through why that is so strong in India and why I think it will remain strong in the coming 5 to 10 years. Capital formation, which is the pink portion, is where the cyclicality comes from. So TFP is in many ways, if you think about or if you read about how this concept of TFP came about, the Cobb-Douglas function, as they say, it was considered to be the residual, right? So if you were counting GDP growth and you said, oh, I've increased the number of workers by X, I've increased the amount of capital by Y, but the GDP is growing by more than that. So that was called the residual, that is called total factor productivity. In a very simple term, this is the pace at which best practices are diffusing into the economy. And this is something that India is doing very well with. If you see the right-hand side chart, this is the same data but presented in rolling 5-year average, so it's a continuous time series. And focus on the top gray line. That is the capital formation 5-year CAGR. And notice that it peaked in 2012 and then it kept falling, and it kept falling at least till this time series, right? So this is about 2020. And if you remember, well, those of you who are old enough to remember, 2012, India's trend GDP growth was supposed to be 8%. So everyone used to model that India will keep growing at 8%. By the time we came to 2019, so well before COVID hit, this number had fallen to 6.5%. So that people had started thinking that India was decelerating. And because of COVID scarring, there was this fear that India's trend growth would slow even further. And I kid you not, 1 year back, there were several senior economists who thought that the growth this year would be 4.8%. Clearly, I mean, so that the reason why the slowdown happened was a cyclical one. And this is a point I've been making for 7-8 years now, that the slowdown we are seeing is a cyclical slowdown, it's not a structural slowdown. And so therefore now, it is not surprising that we are seeing trend growth assumptions being bumped up. So now the same economists who had 4.55% growth for FY24 are now talking about 7.5-8% growth for FY25. The left-hand side chart shows you the 2014 to 19, these are calendar years, TFP growth across countries. So what you see, so this is China, right? So this is -1.5, and this here is India, 2.4. One of the major factors behind this is the power balance between the private sector and the government. Going back to this chart, if you see this line here, right, this pink line is the 5-year CAGR of TFP. Look at the negative numbers in the 70s. See what happened in the 70s in India as we nationalized everything, banks and oil refining companies and coal mining and everything we could think of. The productivity of labor and capital slowed dramatically. Since then, as we learned that this was not going to work, we have been steadily sort of taking a step back. So in human society, there are 3 major ways to form power hierarchies. One is religion, second is money power or business power, and third is political power. Religion in India is, people may have opinions, but I don't think it's very important for political power in terms of, at least, we are not a theocracy, right? We are not like Iran or the Vatican City. So it's primarily a division of power or power balance between the government and the private sector, the private corporate sector. In China, what happened around 78 when Deng Xiaoping decided to do the reform and opening up is that the state decided to take a step back. 2014-15, they reversed that. What is happening in India now is a continuation of what started in 91. So progressively, the state is taking a step back. When they appoint a private sector person like me as the chairman of Aadhaar, it is a sign that acceptability of private sector people in the government is much, much, much better than it was 10, 15 years back. In fact, 5 years, 7 years back, I would have thought it unthinkable that I would be entrusted with such a responsibility. So this is a very major change, and this is why you see China is now negative, right? So as the state-owned enterprises, SOEs in China control more and more of labor and capital, their productivity, TFP, is actually turning negative because the incentive structures, the market forces are not working. In India, the reverse is happening, and that's a very important factor. The second factor is, if you see the right-hand side chart, this is somewhat old data, an old report. I haven't seen a more recent split of TFP between agriculture, industry, and services. But what you see is that in agriculture, TFP growth rarely crosses 1%. As you can imagine, it's a very large, fragmented base. Farmers are generally at subsistence level. They struggle to take risks, and therefore their productivity growth generally does not improve dramatically. Industry, we have so far struggled, and I'll have some charts to explain why this can be a bit better going forward. Services is where we are really excelling. And services, what does it include? Things like trade. If you think about all these rows and rows of retail stores, imagine the shopkeeper sitting there idle for most of the day. Sometimes there will be replication of inventory. The lighting, the access, so all of those things, and in fact the pace at which you can purchase, all of those things are much more inefficient than, say, in a modern trade store. So as modern trade goes from, say, 4% to 5% to 8%, the impact on productivity is significant. Same with phones, right? So telecom is a very big service. And as we go from 2G to 3G to 4G, and adoption really widens, we see dramatic changes. But we are trying to catch up to the productivity frontier so we can move very fast. But another major factor of productivity growth in services is the pace at which we are absorbing foreign technology. So the biggest impact of China entering WTO was not just that they managed to export a lot, but also that they got foreign technology. So they got a lot of, in 2004, nearly 60% of Chinese goods exports were by multinationals operating in China. Now, that number has fallen to 30% now, and even today, only 7% of Chinese production is for exports. So what happened as the technology got diffused in is that Chinese productivity shot up. We have so far not been very successful in doing that for goods, but we have been remarkably successful in services. So what you see on the right-hand side chart here is modern services trade, which is anything that does not require physical presence. So our global share of services trade is about 4.5%, which is the black line on the right, and that of modern services is 8%. Just for perspective, our global share of GDP is about 3.5%. So this includes not just IT services, which of course in Bangalore, we are the hub of that, but it includes now business services, accounting services, consulting services. As services value chains are fragmenting, see, one of the reasons why global goods trade really expanded was the containerization and the fact that the same, this phone has like hundreds of parts, and some of them are coming from Japan, some from Korea, some from Germany. The liquid crystals in the liquid crystal display come from Germany. The glass comes from Corning, which is an American company. So there are, similarly in services, if you are, say, in a consulting setup, what you see now is the partner needs to be in front of the client, but everything else now can be done offshore. You can have electric vehicle designs, like the Mercedes-Benz operating system is now being developed in India. You have retail chains globally where global procurement now happens in India. You have oil drilling companies whose data is getting processed in India. So there are remarkable types of services which are enabled by disaggregation of business processes and very wide pipes which can transfer lots of data into India. And this is expanding at 35 to 40%, the pipes. And this business is growing very rapidly. I think that business services exports are going to be more important for India's economy in the next 20 years than IT services have been in the last 30 years. Now, this is not just about the dollars that we create or the jobs that we create. We get expertise. So 20% of chip design engineers in the world now sit in India. And we are starting to, so if someone, say tomorrow some auto company in India wants a electric vehicle designer, they don't need to go to the US. If some Indian retail chain wants a global procurement expert, they can come to Bangalore. They don't need to go abroad. So this is another major driver of productivity because we are starting to get the best practices from the world in inventory management, in business processes, in accounting, in design. So from a structural perspective, I want to spend some more time on not just this chart, but on TFP. There are several changes that are also happening in terms of physical infrastructure. So highway construction, railways, capex, these are all growing dramatically. What is also happening is sharp improvements in micro infrastructure. What is micro infrastructure? This is, see, the infrastructure that we discuss, like airports and national highways, the Delhi-Mumbai expressway and all that, is meant to carry large groups of people or goods. Micro infrastructure is what helps individuals. So if you read a book, Claudia Goldin's Career and Family, she's a Nobel laureate last year in economics. She writes about how till the 1920s, women in the US had only two options, career or family. I mean, you could either have a career or you could have a family because even the US didn't have electricity in every house. There was no home automation. There was no central heating. There was no sewage systems. And infant mortality was very high. By the 1940s, all of this had changed. So washing machines, refrigerators were easing the workload at home. Penicillin had brought down infant mortality significantly. You had central heating and sewage systems and piped water. And now women could save time from at home and therefore could afford to work abroad, outside the home. This is what is changing in India now at a very rapid scale. So in 2011, only 29% of Indian households had access to dense energy. Today, it is 71%. You had very basic electricity availability even till I would say 8-10 years back. Today, rural women in rural Bihar are grinding their masalas with mixer grinders because electricity is available. These are all productivity drivers, and therefore I think TFP growth can be well above 2%. So coming back to that first equation, 1% growth in labor, 2% growth in TFP, right? So we are talking about 3% growth from what should be called structural factors because these are things that don't change very quickly. Now we come to the cyclical factors. Among the most cyclical of elements is housing. And it is shocking to me how little attention is paid in policy making in India, perhaps because it is a very local and a state subject, in terms of managing the economic cycle. If you think about your household's expenditure and think about how much your household spends on food and clothing every year, multiply that by 30, it would still be less than the amount that a family pays for a household. And so the purchase of a house is one of the most important and the largest capital formation events in the life of a household, because after 30 years anyway, the kids graduate and then move on. Now, what you see on the left is, and focus on the maroon line, that is the reason why, that is the primary reason why India's capital formation slowed. Because we were going through a very sustained real estate downturn. So what you see on the right is the sales in the top 8 cities of India. And you can see this here was 2012, where the price to income ratio peaked. So the real estate prices, after a decade-long upturn, had become too expensive. Then house sales started to fall. The developers kept building, and so you can see how the inventory, months of inventory kept shooting up. This was demonetization. As you know, a lot of cash is used in real estate. It is still used, but a lot less than it was a decade back. And then we saw a sharp collapse, consolidation in the real estate industry, slow recovery. Then here, there was a firm called ILNFS, which was a 1 trillion rupee. At that time, it was a lot of money. Even today it is. But its collapse triggered a crisis in the non-banking financing companies. And then Indiabulls Housing Finance, Diwan Housing Finance, all of these firms collapsed. And then the real estate industry again took a beating. Slow recovery, and then COVID hit. This number, in fact, the last quarter, has now hit 300 million square feet. So what was stabilizing at, or it was falling from a 150 million square feet number, is now at 300 million square feet. So inventory months have fallen further, right? So if you have very low inventory now, houses need to be built. And when these cycles turn, remember that India is a very young society. So the number of households is still expanding at 2.4% a year. The average size of a house needs to expand a lot. The value of construction per square foot needs to expand a lot. Just for perspective, the average size of an Indian house is about 460 square feet. So with 4.5 people, we're talking about 100 square feet per person. In tier 1, tier 2 cities of China, which are expensive cities like Shanghai, Beijing, and Guangdong, you have Guangzhou, you have 250 to 300 square feet per person. In tier 3 cities, where real estate is cheaper, it is 500 plus square feet. In the US, it is 700 square feet per person. So I'm not saying we are going to go there very quickly, but this square footage per person can continue to expand. If you think about construction cost, a rural household going from a kacha house to a pakka house pays about 300, 400 rupees a square foot. The moment you get into a 5-story apartment in an urban area, you're talking about 2,500 rupees a square foot, because you need reinforced concrete, you need staircases, you need a lot of other investments. Now, despite all that, you see this decline, 6% of GDP decline in the value of construction as a percentage of GDP. So this was a substantial decline, and this cycle is now turning. When this cycle turns, it does not turn back very quickly, because when people start, because what has also happened is incomes have grown, real estate prices have not grown, so affordability has improved, and we are starting to see inventories get cleaned out very quickly. There will be cities where there is perhaps going to be a very quick downturn as well, but as a country as a whole, I think this is a very important driver of investment. The second big driver is capital investment. So what you see is capacity utilization. You can see we are back to pre-COVID levels. In things like thermal power, we are already at 2015 kind of levels. At peak deficit, so this is the, as you know, power demand tends to be quite volatile. So you have, there are periods during the day where power demand peaks. Because we haven't added capacity, see here, okay, so this seems to be distorted, but see, this is 10%. So between 2008 and 17, this is fiscal years, we were adding capacity at 10% a year. Between 17 and 23, we've added at 4% a year. And this 4% includes a lot of solar and wind, which runs at very low utilization. So effective capacity growth was more like 1%. So obviously now, in October, we saw that we ran out of capacity when demand peaked. I think in another month or so we're already in March, maybe by the end of this month, early April, as the heat waves hit and we are in the middle of election season and state governments don't want to give power cuts, we will start seeing deficits again. So we now need to add a lot of thermal power capacity. Just a year back, the Indian Central Electricity Authority had said that we don't need to add any more thermal power capacity ever. And within a year now, we are seeing 80, 85 gigawatts. So this has changed. So capital formation needs to pick up. What we are also starting to see, if you see the right-hand side chart here, is the projects under implementation. So UI means under implementation. What you can see is that projects under implementation are starting to go up from the private sector. The center is, the governments have been steadily improving because their fiscal condition, or rather their spending patterns tend to be quite predictable. The cycles actually get formed mostly because of what the private sector does. So you can see after almost a decade-long decline in the value of projects under implementation, they are starting to go up again. And you can see the new announcements have picked up. This YTD, I mean, fourth quarter is when a lot of the announcements happen. And so we are going to see substantially more announcements, a very large increase in announcements happen this year as well. All of this is happening despite several headwinds. So we are seeing the need to do fiscal consolidation. So you see the left-hand side chart, the government has been bringing down its fiscal deficit, as it must. This is very, very important from medium-term sustainability perspective. But as you know, if you bring down the fiscal deficit, the economy starts to slow. If you add to fiscal deficits, the economy accelerates. So this was required during COVID. Government bore nearly 60% of the loss of income during COVID, but we are now starting to see this decline. This debt to GDP needs to be brought down to these kind of levels before we can breathe easy. Some of this can happen because of improvement in taxes. So you can see direct tax to GDP, which is income tax to GDP, has been rising. This was a period between 99 and 2019 where it was growing at about 5 basis points a year. Since then, it has been growing at about 20 basis points a year. So there's been a substantial improvement in the pace at which we are collecting taxes. This would help in the process of fiscal consolidation, and this actually improves, in some ways, productivity as well. But where I see the biggest change happening is in corporate taxes as percentage of GDP. So you see between 2003 and 2008, we saw an increase of nearly 2.5% of GDP. So went from 1.5% to 4% of GDP. We are likely to see this number, which was falling for all of the previous decade, start to go up now again as corporate profits are now growing faster than GDP again. Market borrowing, so the government is also now no longer crowding out. So as government borrowing goes up, this is classic economics. As the government borrows too much, the private sector is then short of resources. So the government is ceding space, and this is also, I think, very, very constructive and a very positive thing for the private sector as it goes about doing the new capex. The second big headwind is monetary tightening. So as you know, the RBI has been raising rates. I'll spend some time on this chart, which is also a form of monetary tightening. This is the effective money injection by the RBI. So what you see here is that the effective money injection by the RBI in the last 18 months. So just for those of you who don't track economies for a living, as the economy grows in nominal terms, and our nominal growth in the economy is 10-11% a year, if you're lucky 12, you need more and more money, right? So you're trying to do more transactions. This money is either created by the RBI or is created by commercial banks. What you are seeing on the right-hand side chart, that over the last 18 months, the effective money injection by the RBI is negative. So why are they doing it? The objective is to smoothen out the economic cycle. So what the RBI is doing and what the government is doing with its fiscal consolidation is to give predictability of growth. Tell the corporate sector, the private investors, that you are going to be seeing a steady growth pattern, a steady inflation pattern, a relatively steady currency. And then with that predictability, you are allowed to invest again. You can then invest again with slightly more certainty than you would have had otherwise. And so in trying to control inflation, the RBI is actually slowing down growth. So whatever the 7.5% growth that we are seeing today is despite the headwind on the fiscal side and the headwind on the monetary side. We're also seeing a slowdown in growth of exports of goods and services. So this is a global cyclical slowdown. As I said, the world is also about 1.2 years behind where it would have been. But and I think it is worsening, and I'll spend some time on that as well. And this is actually a major headwind for us. So as we manage the economic cycle, we have to very tightly calibrate, or very deftly calibrate the pace of fiscal intervention, the pace of monetary intervention, because the headwinds from the external front are actually quite intense. And now I want to spend some time on what I think is the biggest risk for us, which is rising global cost of capital. So, as you manage economic cycles, you focus on two major variables. So you do fiscal expenditure. If the economy is going down and the momentum is weakening, you try to do fiscal expenditure. The government chooses to borrow from the future, borrow and basically spend future taxes today so that the economic momentum is sustained. And the second is monetary measures. So you bring down interest rates so that the private sector can borrow again and start spending, or consumers can borrow and start spending. Now, what the US did after 2008-9 is that it tightened fiscal conditions and it eased monetary conditions. So it brought down interest rates to zero, started printing a lot of dollars, made it very cheap to borrow, and the government slowed down its own expenditure. What they've done after COVID is exactly the inverse of that, because that policy didn't work. And this is the remarkable strength of the US, that they are very pragmatic about their policy making. So they realized that the tight fiscal, loose monetary didn't work. It caused a lot of inequality. The inequality actually worsened, so wealth inequality became really bad. And unemployment took a very long time to get rectified. So now they've inverted it. So now they're doing fiscal easing and monetary tightening. So higher interest rates and an easier and a higher fiscal deficit. Now, what you see on the left is the projection by the Congressional Budget Office of what the fiscal deficit number is likely to be over the next 10 years. They give a 10-year target. So we do 1-year targets. The US works with 10-year targets. So you can see that the fiscal deficit in the US is likely to keep expanding. And their debt to GDP, this is the most worrying line, is going to be rising steadily. It is already higher than where it peaked in the Second World War. Now, this is an unsustainable pace or an unsustainable level of debt to GDP. This is, I think, the biggest risk to the world. What has happened is that the fiscal deficits that the CBO has projected, about 5 to 6%, what we are seeing is upwards of 8%. So the fiscal deficits in the US are turning out to be much higher than what the CBO has projected. One of the reasons all this debate is happening on soft landing in the US is because their fiscal deficit has been much higher than what anyone expected. And as you know, when your fiscal deficit expands, your economy sustains its momentum, or actually the economic momentum is boosted. This is not sustainable, because you cannot keep adding to your fiscal deficit, especially if your debt to GDP trajectory, what you see here on the right-hand side, is as bad as it is. They are trying to fund it, and then this perhaps may become too technical, so I'll leave it for the Q&A, but the way they are trying to fund it is also something very dangerous. They are borrowing very short term. So you can imagine that the largest borrower in the world, 80% of the US federal borrowing last year was in T-bills, which is less than 1 year duration. So this is, I think, a very dangerous situation, in my view. And they may be able to kick the can down the road till the presidential election later this year. But sooner than later, I think the cost of capital, so the US 10-year bond yield is the cost of capital for the rest of the world. It is going to be rising very rapidly, and it will be much, much higher than what we were used to. And this is something that we need to keep in mind. So this is, again, what I would call a cyclical risk to our economy. This is what I was saying, that, notes and bonds. So as you know, when a government borrows, it can borrow in T-bills, which is less than 1 year duration, in notes, which is 2 to 10 year duration, and bonds, which is 10 plus, up to 30 years duration. You can see the gray line here, which is the outstanding stock. So 75 to 80% of government borrowing in the US, the stock is notes and bonds. flow over the last 12 months, this is less than 20%. This is a very dangerous situation because, as you can imagine, if you issue short-term securities, you have to go and refinance them repeatedly. And that, I mean, there is currently about $8.5 trillion of T-bills outstanding. This, I think, is a major risk because at some point they will have to refinance this with longer-term bonds, and those yields will then become a huge problem for the rest of the world. What does this mean for us? Among other things, this means slower inflows of capital. So when they do monetary easing, there are what we call spillover effects. So if the U.S. Federal Reserve prints a lot of dollars, they start spilling out of the U.S. They come to our domain as well. I mean, venture capitalists thinking that you can make money 15 years later, that's fine with us. It was all because the cost of capital was near zero. The moment the cost of capital goes to 4%, suddenly the business models change. So people start saying, why should we? Because, you know, the discount rate that you apply to future earnings goes up significantly. What you see here is the price to earnings multiple of the Nifty. Now, this was the time when 13 to 14 times forward was considered a good multiple for the Nifty. Because of a sustained monetary easing stance by the US, this has gone up to 18 to 20 times. And this is again, I think, going to fall. It should not fall to 13, 14. India is a much stronger economy, a much less volatile economy than it used to be. But this number, I think, in the next 5 years is going to be a lot lower than what we are currently seeing. And this is something that's going to happen to asset prices the world over. They'll need to get marked down because the cost of capital. In fact, there's a fascinating book, The Price of Time by Edward Chancellor, which talks about how in the last 350 years, every time we have seen a sustained period of low interest rates, and that has been followed by a sharp rise. Because, you know, when you see very low interest rates, you tend to misuse that, which is what the US federal government is doing right now for their, you know, near-term political gains. It pushes up rates, and when that happens, something or the other breaks, and that's something that we need to keep worried about. India's earnings trajectory is quite solid because, and therefore, I think the markets in India will remain less volatile, but we need to be very cautious on the PE multiple. One last point, and I'll close. This is to do with why, and this is a question I get repeatedly asked, and I thought it would be relevant to you as well. You know, consumer companies asking that, oh, the GDP is grown at 8%, or GDP annual growth is 7.5%. Why are we growing at 2% or 3%? So one of the things that has happened over the previous decade in India is that the labor share of income was going up, right? So in economic frameworks, if 100 rupees is being earned, how much is going to capital, how much is going to labor is a very important division. And all of last decade, the labor share of income was going up. This was very important for reducing inequality. So if you saw the recent consumption survey, between 2012 and 23, the consumption inequality in India went down. So the Gini coefficient of consumption actually went down. The share of consumption by the top 10% fell by 4% points. So there was a substantial reduction in their share. This was because labor share of income went up. What we are seeing now is the reverse of that. So what has happened is that the worker population ratio, the participation ratio is going up. I was telling you briefly about women coming back into the workforce in rural areas. I mean, so getting more free time, perhaps with roads and phones coming in, labor markets are more accessible. So as they come in, participation ratios are going up. What happened during the pandemic is that, you know, industrial capacity addition slowed down as well. So you had a slowdown in demand, and you also slowed down the factory construction. So when the lockdowns were lifted, the factories started getting built again, and demand also came back, right? So it was kind of synchronized. But you couldn't slow down the supply of labor because people who were turning 21 kept turning 21 throughout the pandemic. So now you have 1 to 1.5 years. As we said, our economy is about 1.2 years behind where it would have been. So there's about 14, 15 million workers extra in the economy right now. And that means that labor currently does not have pricing power. So we are starting to see real wages not grow. There was a period where real wages were continuously expanding the previous decade. So we are in a very different stage of the cycle. For those of you who are interested, you can read about Kuznets curves. So what happens is inequality at a certain stage starts to, so there's a structural aspect to it as well. So as our economic productivity rises, the surpluses are initially usurped by the top 20%, 10%, 15%. So there is a structural aspect, but there is also a cyclical aspect here. So you are seeing that. The second big problem is that during the pandemic, own account enterprises slowed down dramatically, right? So in India's household incomes, 40% is wages, 35% is surpluses of own account enterprises. So these are like small shopkeepers, the dhabawalas, the neighborhood tailor, Master Ji, the tourist agents in Agra or whatever tourist spot, and the small bus drivers. So all of these own account enterprises were really struggling during the pandemic. And they saw a very steep decline in their incomes. Their balance sheets have been badly broken, and they are likely to see a much slower recovery. But as they come back, they are giving very tough and stiff competition to some of the larger companies. These are not all informal. Some of them are registered. As you can see, the number of companies reporting profits flattened out till FY22. We don't have 23 numbers yet. But so this was a very major reason. This is another major reason why consumption in the bottom 60-70% is not very strong. But as capital share of income rises, it helps the top 20%, which is why the sales of luxury cars, luxury apartments, SUVs, they're all doing very well. Refrigerators above 250 liters doing very well. Refrigerators below 150 liters not doing very well. So all of these are trends that are not temporary. They are going to sustain for a while. And some of the larger companies, making pizzas, making sherwanis, making soaps and shampoo, all of them are going to see increased competition as some of these smaller firms really come back into the market. So to summarize, from a structural perspective, I think we are well endowed. We are seeing 1% plus growth in labor, 2% growth plus in 2% plus growth in total factor productivity. And on the cyclical side, there are several variables, which is we are seeing a pickup in real estate investments. We are seeing a pickup in corporate investments. We need to see headwinds, and so we will see headwinds from the government doing fiscal consolidation. Interest rates are going up in India and abroad. But net, I think we should see 4% plus capital formation growth. And as we think about the next 5 years, we will see the economy growing at 7% plus. Within this economy, to summarize what I said at the end, it will appear to be a slightly unequal growth. So we should be ready for that. I mean, there will be political implications of that. There will be shifts in government policy that will be necessitated. But this is not something that gets corrected very quickly. I mean, Kuznets curves last 30, 40 years. I'm hoping this will not last that long. But we will see a rise in income and consumption inequality in the next 4-5 years. On that account, I'll stop, and perhaps we can do some of the questions.
And this is slightly different, Neelkanth, which is about the quality of data. In India, for several years, we've been talked about the quality of data in India is not as good as it ought to be for an economy of our size. Given that you've seen the time series on this, do you see an improvement in that? Are we getting better at that? And again, in the context of what we will see in the changing in the CPI, the new CPI that will come, the Consumer Price Index inflation. Again, it's a new series with the new weightages. So one on the quality itself, and then the changing component, it'll be good to get your thought.
Yeah, so, no, I think quality is pretty bad, and it's only become worse. So for example, the industrial production data, the IP data, it's just not worth paying any attention to. It is completely, disconnected from reality. And, in a fast-growing economy, see, remember that we are growing at even if you grow slowly, 6.5%, 7%, the economic structure keeps changing. So like, for example, the IP data still has handset manufacturers, and when the samples were created, Nokia still had a factory in India. Right? And in their samples, all of these new smartphone factories are not there. The way cars were manufactured was very different. A lot of the new factories of, some of the, like Mahindra, Tata, etc., are not part of that benchmark. So in a fast-growing economy, you need to keep doing these surveys every 5-6 years. The fact that we had to discard a 2018 survey, because surveys were done, but because this was just after demonetization, they had to be discarded, as I think, and then COVID delayed us for another 2 years. So the quality of data currently is really bad. And with the consumption survey coming out, and the government is really trying to push this forward, though I think we'll need a much bigger overhaul. So at least in CPI, we will start to see slightly better data, right? So food weight, I think even 43% seems too high to me in the consumption survey, but they are what they are. But processed food has gone up, so maybe there's some appropriate change. But conveyance going up. So it is much more representative of current consumption trends, and therefore a better measure of CPI than what the previous CPI was. So we will see these changes, but I do think that India's statistical system needs a complete overhaul.
And I want to ask you another, today a lot of we live a life of social media. How much do you think social media is impacting policy thing? Because you're supposed to take policies, because you talked of cyclical, structural, but then social is ephemeral. It's instant, and so. Yeah,
so no, that's a fascinating question. I need to think about it a bit before I answer. See, a lot of decision making is, and especially if you're a politician, you're looking for feedback. See, they say, for example, that Trump is a terrible leader but a great politician. So when he started his campaign, whenever he talked about China, I saw that it resonated with people. Whenever he talked about immigration, it resonated. So then he spoke more about it, and he got better feedback. And so politicians also rely on this feedback, and I think social media allows that feedback channel to open up. And that I think, so you see some of the policy changes where they announced and within minutes or within hours and days they get reversed. That does happen. But in terms of, and I do think that it allows, if you use it constructively, of course you can use it destructively also, but if you use it constructively, it allows for communication to happen much faster. Think about the pace at which budget policies used to be discussed, like 20 years back. There were fax machines, and people would spend the night looking at that, and there would be person sent to Delhi to fax the budget documents in the bundle, and then you analyze. And today, when you go to Twitter, and in like 2-3 hours after the budget, you pretty much understood everything, right? So, and that's great. I think it allows people to understand the key messages of the budget much faster. So, but you have to use it better. You have to use it better because sometimes the narrative can very quickly go out of your control. So there is this book called Mega Nets. I don't know if you've read about it. It says that Facebook is not in control of Zuckerberg. that Google's search and the algos which prioritize those links are not in control of Google itself, right? Because once you set the feedback loop going, it becomes it has its own rhythms and cadence. So social media and how to sort of control the messaging is actually a very big challenge. But it definitely speeds up the feedback loops and the communication.
Sure. I'm going to ask you one other question before I open it up. And you talked of inequality and that kind of a thing coming. But if I were to take a slightly different lens on that, on the social sector spends, do you see that as you see the way the government tighten and improve its fiscal position, do you see the impact of that happening on the social spends? Because we have seen some spends in some sectors dropping I think, what's your take and how do you think we will see it structurally going?
See, from the...
Or is there a space for the private? Is that what they're thinking?
No, I don't think the expectation is that the private sector will step in. I think the government, the central government realizes that health and education are state subjects. There is very limited, and they really complain, right? So if you start launching centrally sponsored schemes, this is one of the biggest criticisms that the finance commissions have offered, that, you know, when the central launches a CSS, a centrally sponsored scheme like Pradhan Mantri Gram Sadak Yojana, you say that X% I will spend on a state subject, but then you have to spend Y to make it 100%. And the states complain that, well, this is your priority. It is Pradhan Mantri Gram Sadak Yojana. Why am I spending my budget on it, right? So there are constraints to that, and implementation is always a challenge. So I think that there is a serious, I would say, capacity issue. For example, in railways, there was this, for the longest time, fiscal capacity or fiscal capability was not the constraint. It was the ability of the railways to invest, which was the constraint. And I think health and education, I think the problem is ideas, not money.
Okay.
So if we can get good schemes, good ideas through to the central government that can be executed from the center, I think funds will get allocated. Because frankly, another ₹500 trillion here or there is not something, you know, the government spending is nearly 50 trillion rupees. So it's not something that will really break the bank. That's my understanding. I mean, I'm not the one making budgets, but I think it is a lack of ideas more than lack of funding which is the issue.